You skip the risky move. You say no to the uncertain opportunity. You keep your money exactly where it can't surprise you. It feels responsible, controlled, almost impressive if we're being honest. You're not chasing trends. You're not gambling. You're doing what financially mature people are supposed to do. And yet, months pass, then years. Nothing really changes. Your balance is still there, quietly behaving. No drama, no losses, no growth worth mentioning either, but at least it's polite. Meanwhile, someone less careful, less prepared, somehow pulls ahead. Not by luck, not by genius, just by doing something you chose not to do. And that's the annoying part, because your decision still feels right. So why does the outcome feel off? You're not careless. That's the whole point. You think before acting. You compare options. You read, watch, analyze. If something feels off, you step back. If it feels rushed, you wait. You don't jump into trends just because everyone else is doing it. You don't throw money into things you don't fully understand. You give yourself time to feel ready. And honestly, that sounds like intelligence. You save consistently. You keep a safety buffer. You avoid decisions that could backfire. On paper, this is exactly what financial discipline looks like. And it feels good, because every move has a reason behind it. Every delay feels justified. You tell yourself, I'm just being smart about this. So you postpone investing until you understand every detail. You avoid opportunities that come with uncertainty. You lean toward stability, even when it barely moves the needle. It's not fear. That would be irrational. This is logic. Thoughtful, measured, responsible logic. At least, that's how it presents itself. Here's where it starts to break. These decisions don't fail in a dramatic way. There's no sudden loss. No obvious mistake staring back at you. Everything looks fine. Your money is still there. Your plan still makes sense. Nothing feels out of control. But growth? Barely noticeable. Because while you're protecting what you have, you're also limiting what it can become. And the most convincing part is this. There's no clear moment where it feels like you chose wrong. No alert, no consequence that demands attention. Just time moving forward without asking permission. You stay consistent. You stay disciplined. And somehow you stay in the same place. It's a quiet trade-off. Stability in exchange for momentum. And by the time that trade becomes visible, it's already been happening for longer than you'd like to admit. The issue isn't that you're making bad decisions. It's that you're stuck in a loop that rewards feeling right, not being effective. Every time you avoid something uncertain, you get a small sense of relief. No risk taken, no mistake made, nothing to regret. That feeling is subtle but powerful. It tells your brain, good job, do that again. So you do. You start repeating the same pattern, not because it's producing results, but because it consistently removes discomfort. And over time, something shifts. You begin to confuse emotional comfort with financial intelligence. Because real growth decisions rarely feel clean. They don't come with full clarity or perfect timing. They come with gaps, incomplete information, a bit of tension you can't fully resolve. So your brain flags them as risky and quietly redirects you back to what feels controlled, back to what feels smart. And now the loop closes. You choose safety, you feel relief, you repeat. From the outside, it looks like discipline. From the inside, it feels like logic. But underneath, it's just avoidance wearing a very convincing disguise. There are three forces quietly running this loop. The first is comfort, disguised as logic. Your brain is not trying to make you rich. It is trying to keep you calm. So when something introduces uncertainty, your mind immediately looks for reasons to step away, and it is very good at it. I need more data. It is not the right time. I will wait until things are clearer. All of these sound reasonable. That is what makes them dangerous. Because clarity almost never shows up before action. It shows up after you are already in motion. Waiting for it first is like waiting to learn how to swim before getting into the water. It feels intelligent. It just does not work. The second force is the invisible cost of inaction. When you make a bad investment, you notice. There is a number going down. There is discomfort. There is a lesson. But when you avoid a good opportunity, nothing happens. No alert, no visible loss, no emotional reaction. You do not see the version of reality where you said yes. You only see the version where you stayed safe. So your brain quietly records it as a win. No money lost. Good decision. Even if that decision cost you years of potential growth, and because there is no feedback, there is no correction. You keep repeating the same behavior, fully convinced it is working. The third force is asymmetry. Most financial progress does not come from doing everything right. It comes from a small number of decisions that actually matter, and those decisions never look comfortable at the start. They look early, unproven, slightly uncomfortable to explain to other people. So if your filter is safety, you automatically remove them, not because they are bad, but because they do not pass the emotional test. And that creates a strange outcome. You avoid most mistakes, which feels good, but you also avoid most breakthroughs, which you barely notice. So you end up with a clean record and very little progress, and the loop keeps running, quietly, consistently, convincingly. Think about the person who waits to invest until the market feels stable. They watch the news. They follow the signals. They tell themselves they will enter when things calm down. And eventually, things do feel calmer. But by then, prices have already moved. The uncertainty is lower, yes. So is the upside. They avoided the discomfort. They also avoided most of the growth. Or take someone who keeps all their money in savings because it feels safe. No volatility, no surprises. Everything is predictable. Except one thing quietly working in the background: inflation. There is no notification for it, no sudden drop that demands attention, just a slow erosion of purchasing power year after year. It does not feel like a loss, but it behaves like one. Then there is the person who prepares endlessly before starting anything. They research investments. They compare platforms. They consume hours of content. They are always almost ready. Meanwhile, someone else starts earlier, makes a few mistakes, adjusts, learns by doing, not perfectly, not elegantly, but effectively. And over time, that messy progress starts to compound. The difference is not intelligence, it is exposure. One stayed protected, the other stayed in motion. And in each of these cases, the behavior looks responsible from the outside, careful, thoughtful, controlled. But the outcomes tell a different story, because the real problem lives in that gap between how a decision feels in the moment and what it actually produces over time. Over time, this pattern does something subtle. It starts shaping how you see yourself. You begin to identify as careful, rational, someone who does not take unnecessary risks. And at first, that identity feels earned. It matches your behavior. It explains your decisions. But then it starts to limit them. Because now stepping outside the loop does not just feel uncomfortable. It feels inconsistent with who you are. So even when a real opportunity shows up, you hesitate. Not because you do not understand it, but because it does not fit your internal narrative. And that hesitation compounds. Financially, the cost is not loud. It does not show up as a loss. It shows up as delay, missed entries, late starts, opportunities that quietly pass while you are still evaluating them. Time keeps moving, whether you act or not. And eventually, a realization starts to form. You did not lose money. You lost time. And time behaves differently. You cannot earn it back. You cannot invest your way into recovering it. It was the one asset you had full access to that required action to mean anything. And the longer the loop runs, the more expensive that inaction becomes. So the goal is not to become reckless. It is to stop confusing comfort with correctness. Smart financial behavior is not about avoiding uncertainty. It is about choosing which uncertainty is worth engaging with. Because growth always carries some tension, some lack of clarity, some level of risk you cannot fully remove. If a decision feels completely safe, it is probably already priced in, already crowded, already late. The shift is simpler than it sounds. Instead of asking, "Does this feel safe?" start asking, "Does this move me forward?" That question changes what you notice. It changes what you consider. It breaks the loop. Because now you are not optimizing for relief. You are optimizing for progress. And those two rarely point in the same direction. Think about one decision you delayed because it felt too uncertain. Was it actually risky or just uncomfortable? If this shifted how you see your own choices, there is more like this ahead. Like the video if it made you think differently. Share it with someone who is still waiting for the right moment. And subscribe if you want clarity that actually moves you forward.